Anthony, pleasure to have you back on the show, and thanks for joining us here. So first and foremost here, as you're navigating the environment leading up to Jackson Hole, what should be on the checklist for investors that are out there and going to be listening in to what Fed Chair Jay Powell has to say?
Well, first of all, we want to know, and investors need to know, that we're not out of the woods yet with regards to a recession. The economy seems to be going in the direction that we want. We want it to slow down. We want the labor market to cool off. It has. We want the inflation rate to go down. It has. And the Federal Reserve is probably going to lower interest rates in their September meeting. But what that means for you, I think, really depends on the age of life that you're in. If you're in the younger phase of life, then keep dollar cost averaging. Dollar cost averaging is just buying the same thing over and over again. If you have a 401k and money's coming out of your paycheck and going into your mutual funds, that's dollar cost averaging. And the math behind it shows that you actually lower the average purchase price. So don't change anything, whether we have a recession or whether we have a bull market, it doesn't matter. As a matter of fact, a recession actually helps you because as the prices go down and you keep buying the same shares over and over again, you actually get those prices on sale. So don't change anything if you're in the accumulation phase of life, keep dollar cost averaging. If you're in the latter phase of life, though, the retirement phase of life, then it's not so much about building wealth as much as it is about protecting wealth. So at that point, what you want to do is focus on investments that are going to give you income, investments that are going to give you interest and dividends. So if you need to live off of them, you can spend them regardless of what happens in the economy. And if you don't need the interest and dividends, then you can dollar cost average the dividends in and build wealth or continue to grow your portfolio, just like when you're in the accumulation phase of life. So it really depends on what phase of life you're in, Brad, as to how you're going to navigate this.
Certainly. So how about people who have been investing for decades and are entering or nearing retirement? How do you recommend that they allocate their portfolio?
Yeah, so interestingly enough, if you need the income, I think you need to focus more on fixed income. That's going to give you a higher yield. It's going to give you a higher income. It's going to give you something to live off of without ever having to cannibalize your principal. If you don't need the income, then you can be a little more aggressive in stocks. And a 60-40 portfolio for someone who's retired may actually be beneficial because that 40% in fixed income for the first time in something like 42 years has potential to be an actual capital appreciation play as well. So even if you don't need the money, as the Federal Reserve lowers interest rates, fixed income should go up, and you can lock in higher yields now, 5-6% on very high quality investments. And as interest rates go down, the capital appreciation will probably be there as well. So it's not a bad strategy if you don't need the money.
How do you evaluate someone's portfolio that may be very rate cut sensitive? And I ask it from the perspective of if someone is trying to make sure that they are best positioned for when the rate cuts begin, then they could, on the other end of that, be out of position for when those rate cuts start to stall out as well. So how do you kind of best anticipate that scenario and the pathway that the Fed is going to be initiating?
Yeah, and that's a great question. And that's where it becomes really interesting and much more of an art than a science, because what we're going to look at is a couple of things to determine where is that balance going to be. First of all, what you need to know is that if rates go down because the Federal Reserve is being reactive, well, then stocks are going to go down as well, too. And if stocks go down and rates go down, that's good for fixed income because of the fact that it becomes a safe haven. So now all of a sudden, fixed income may go up in light of the fact that stocks go down. Great opportunity to then shift out of fixed income into the stock market. The other thing to think of and to analyze when you're looking at your portfolio is what kind of fixed income do you have? Longer duration bonds are going to react more to every quarter point drop, meaning that longer duration bonds are actually going to go up more for every quarter point drop. So if you have longer duration, that's going to react more than if, in fact, you have shorter duration. But there's also ETFs. And if you have junk bonds or junk ETFs, those are going to act more like stock in a situation when the stock market goes down. So they're not going to act like normal fixed income. So you just got to be careful with that. But the reality is that's this balancing act. And if you do it right, it's very possible that your fixed income could go up in value while stocks are going in down, then creating the opportunity to reallocate at that time.
Anthony Saccaro, who is the Providence Financial and Insurance Services President. Anthony, always a pleasure to see you and get some insights. Thanks so much.
Thank you, Brad.